Your credit score will increase if you pay your mortgage on time. However, if you pay your rent on time, your credit score will not increase and nothing happens. If you ask me, isn't that a bit unfair? Well, the shocking thing is that less than 5% of renters currently have their rent payments included in their credit report. However, guys, the good news is that Fannie Mae is trying to change this dynamic, which in the past has made it harder for renters to qualify for an affordable mortgage and eventually buy their own home. So first-time home buyers who want to transition from paying rent to owning a home could benefit from a new underwriting program from Fannie Mae that allows lenders to consider rent payment history. Hi Joe, welcome back to my YouTube channel, and in today's video I'm going to tell you everything you need to know about this new change with Fannie Mae that is going to help renters qualify for purchasing their own home. However, before we go any further, make sure to subscribe to this channel and don't forget to hit the notification bell so that you never miss any update. Alright guys, so without further ado, let's get into this. Well, first of all, we need to understand what Fannie Mae actually is. So Fannie Mae is a government-sponsored enterprise which became a public traded company back in 1968. So the Federal National Mortgage Association, or Fannie Mae, was founded in 1968 during the Great Depression. It was founded as part of the New Deal, and its purpose is to expand the secondary mortgage market by securitizing mortgage loans in the form of MBS. And what this does is it helps lenders reinvest their assets into more lending. As a result, the number of lenders in the mortgage market increases since the reliance on locally based savings and loan associations is reduced. With that being said, guys, let's talk about the brother organization of Fannie Mae, Freddie Mac. So Freddie Mac is a public government-sponsored enterprise headquartered in Virginia. The Federal Home Loan Mortgage Corporation, or Freddie Mac, was ranked number 41 on the Fortune 500 list of the largest U.S. corporations by total revenue in 2020. Now, as per the latest reports, Freddie Mac has more than $2 trillion in assets under management. So founded back in 1970, Freddie Mac was created to expand the secondary market for mortgages in the U.S. It purchases mortgages on the secondary market and then pools them to sell them back as mortgage-backed securities to investors on the open market. Alright, so you may be wondering, how does this help? Well, this process increases the supply of money available for mortgage lending, which increases the money available for new house purchases. Now, it was announced in September of 2008 that Freddie Mac and Fannie Mae had been put under the conservatorship of the FHFA by FHA Director James B. Lockhart. Alright guys, so now I want to discuss some of the great benefits of home ownership and why you should consider owning a home. Alright, so we all know that purchasing your home is the biggest financial decision of your life, or at least it's one of the biggest financial decisions of your life. But you may be wondering, why do you need to buy a house? You might want a house to raise your children in, or you might want to have a yard. What's important to remember, guys, is that the benefits of buying your own house do not come without costs and limitations. Now, for some people, renting might be a better option, so I would highly suggest that you analyze your own personal situation and figure out whether you should buy your house or not. Now, it is worth noting that the pandemic has hit the housing market. And what I mean by that, guys, is the prices of houses increased in early 2021 at the fastest pace seen in 15 years. Matter of fact, reports suggest that most affordable houses rose by 16.5% year over year. Experts are saying that the boom in buying and selling of houses will continue for the next several months. Alright, so one of the best reasons to buy a house is that it's an excellent long-term investment. Now, on the flip side, it is true that houses can lose value, but that happens rarely. And in the long run, historically, values tend to go up. Also, besides that, the land will become more valuable, right? Think about it, they're not making any more land. And buying your house means that you're building up equity over time. Now, for those of you who don't know, equity is basically the difference between what a person owes on their house and the current value. So as you pay down your mortgage, your equity will grow. Now again, on the flip side, you should also note some of the disadvantages of buying a house. So while one of the advantages of owning a house is stability, it also means that it'll be more difficult for you to move to another city. Not to mention that there are high upfront costs. In fact, closing costs on a mortgage can be 2 to 5% of the purchase price. Now, if you are interested in buying your first house, a great way to do this is through the FHA program. So the FHA program is a government-backed mortgage which is issued by the Federal Housing Administration. So FHA loans require lower down payments and credit scores as compared to several other conventional loans. This makes FHA home loans popular with first-time home buyers. Now, FHA loans come in 15-year and 30-year terms, and the interest rates are fixed. The flexible underwriting standards of the agency are designed to help people who don't have pristine credit scores or a higher income buy their first home. However, there is a catch. You as a borrower will have to pay FHA mortgage insurance. This insurance covers protect the lender from loss if the borrower defaults on the loan. Now, the minimum credit score required for a conventional loan is 620, while the minimum credit score required for an FHA loan is 500. With that being said, guys, let's talk about the recent policy change made by Fannie Mae and what it means for you. By the way, guys, if you're enjoying this content so far and have found value in the video, please be sure to hit that like button. Alright, so here's the deal, guys. The recent policy change in August is that Fannie Mae announced that it would consider on-time rent payments history as part of mortgage approval. This means that it will allow more aspiring home buyers to get their mortgage approved and receive home loans. So according to the most recent report, Fannie Mae will start incorporating rent payments in its risk assessment process starting September 18th of this year. As per the research conducted by Fannie Mae, lenders often factor the history of consistent rent payments of first-time home buyers as a significant difference between their qualifying and not qualifying for a mortgage. The goal of this new policy is to help low to middle income borrowers. These are the people whose mortgage applications are often denied because of little credit history. And after the new change is implemented, consistent rent payments will help those buyers improve their eligibility. However, on the other hand, any inconsistent rent payments will not negatively impact your ability to qualify for a loan. The eligibility requirements are that you should be a first-time home buyer, pay a monthly rent of at least $300, and lastly, you should buy the home as your primary residence. Also, the applicant should have been renting for at least 12 months or more. Now, Fannie Mae states that many renters believe they will never be able to buy their own home because of insufficient credit. We can responsibly expand mortgage eligibility by including positive rent payment history and underwriting risk assessment. Now, did you guys know that around 20% of the entire U.S. population has a very skimpy credit record? Additionally, reports suggest that around 30% of Black consumers cite credit history as their biggest obstacle to getting a mortgage. Alright, so if you're wondering how this change works, well, it's an automated system of Fannie Mae which will determine that a mortgage is not eligible to be bought. It will then check 12 months of rental payment history, and if you've been paying your rent on time, it will help improve your credit score. Fannie Mae will then tell the lender, which can then ask the borrower for permission to examine their 12-month bank statement. Now, you as the borrower will then agree, and the lender will order a report from a Fannie Mae approved tech vendor, which will then check the bank statements for rent payment. And the good thing is, guys, is that if your rental history matches the amounts on your application, your loan will get approved. Alright, Joel, so what are your thoughts about this recent change to factor in rent payments for mortgage qualification? Do you guys think it's a good idea? I would love your feedback. Alright, that's all for today's video, and I appreciate you guys watching. If you liked it, make sure to give it a thumbs up and share it with your friends on social media. Also, don't forget to share your thoughts and valued feedback with us in the comment section. Lastly, if you've not already subscribed to this channel, subscribe to it and press that notification bell so that you'll be notified each time I drop a new video. Thanks again for watching, and until next time.